No, but for those of you who are here, I mean, there's a lot of you here early, so thank you very much. We'll have Matt introduce himself shortly, so I'm not skipping some stuff. I just need to make sure that we had it all up and working. If you do have any questions, Matt and I have a short agenda. We're pretty good at flow, we think. But in the realm of trading setups, just ideas of things you want to look for to structure your trades, Matt's a former trader and head of education over here for trading, so he's the man to ask or to talk to about that. Maybe you can trust but verify some of the things I typically say on the webinars. I wanted to have him talk about Captain Condor. By the way, the Captain Condor thing is very interesting. And then we're going to talk a little bit about earnings. HIMS is tonight. Quite an implied move for that. And then obviously NVDA is a big one tomorrow. So we'll talk on that. All right. We're going to mark this as the official start. It is now 1 o'clock. And so Matt, we've been bantering a little bit. We will remove all that first part when we post this recording later. But thank you everyone for joining us today. I am, of course, with the esteemed Matt Cashman, who is, you and I were on a panel not too long ago where we actually got to meet each other, but you are head of education, right? Why don't you give a little background on yourself?
Yeah.
People know.
Technically, my title is Principal of Investor Education at OCC. That's what's on my business cards, but in real terms, what that means is that I am one of 4 people on a team, on the investor education team at the Options Industry Council, which is the education arm inside the OCC. And our job is to basically teach people how options work, with the idea that a more well-informed investor using options is a person who just makes better decisions and understands the product much more broadly. And so everything that I do, essentially, I do a lot of things like this, but also in-person events. I spend a lot of time talking about options in the options market. And my background is, as you said, I was a market maker for a very long time, probably 22 years. I started in the late 90s trading single stock options on the floor of the CBOE. And then I moved to London and traded interest rate options there. I've also traded commodity options for relatively large market making firms in Chicago that we won't mention here. And then came back to the United States and started and ran an index options market making business with 3 other partners that we ran for about a decade. And then wound that down in 2015. Now I work at OCC teaching people how options work. So that's the full circle of life story for me.
That's awesome. I'm super excited to have you here, obviously, because people always want to know, people always want to talk to the guys that make the sausage, the market making sausage. So here you are live for us, which is awesome. And so again,
I did make a decent amount of sausage in my day.
That's right. And so, we always love talking to not only trading practitioners, but people who see kind of behind the veil of the market making kind of dealer operations. And obviously a lot of what we do here at SpotGamma is try to forecast how we think those market makers and dealers will shift their hedging flows. And so maybe you can peel back a little bit of the veil there. So if you do have any questions as we come along here, we'll be looking through the chat to make sure we get those questions. But I will be the first to kind of kick off here a couple of things. And so hopefully everyone can see my screen okay. Matt, can you see that screen okay?
Yes, sir.
All right, cool. So the kind of the softball I think that we're going to throw at you to kind of get you warmed up here is we have some interesting earnings events coming up today, today and Wednesday. Some of these stocks, which is interesting about the options market, and I guess what I'm going to say about this is there's these interesting names, like HIMS comes up today. This is a name here. We have our earnings, our earnings chart where we have the implied move here on the y-axis and the date. So we have NVDA coming up, but the big thing that I'm looking at is we apparently have HIMS tonight, which is at 4 o'clock. this is one of those stocks where, a month or two ago, no one really traded it, and then all of a sudden it just catches that retail investor, attention, and then the options volumes pick up, they spike, and the vol gets really quite heavy. This implied move of 19% for an earnings date is really rather elevated. What do you, a lot of people have these earnings, hey, earnings is coming up, I want to put this trade on, I want to figure out how I'm supposed to trade this thing. Here's 1 month skew for HIMS. When you start to assess an earnings event and trading around an earnings event, what is it that you look at? Kind of what are the parameters or guidelines? What are the things that we should think about as retail traders to sort of figure out if we want to even, structure a trade around something like earnings, or if we should just say, I got to take a pass?
Yeah, I think it's a good question. One of the things that I think the first thing you have to think about when you're the setup that you give there is really interesting, which is that the stock itself theoretically had very little chatter about it. No one really talked about it. And then all of a sudden it catches fire and everyone starts to talk about it. And then of course you see that, the implied move of 19.34% or whatever, the implied vol is telling you. That's telling you obviously that there's a lot of people in there buying options, and not as many people selling them, at least right now. But
I just want to interrupt. I don't mean to interrupt you. Stock's up 120% from February 1st.
That's a lot. That's a lot. I mean, when you put it in that context, when you look at like just in 25 days or whatever, that the stock's up 100+%. I mean, I'm not going to tell you that you're wrong to say that it might move 19.5%, but I do think that whenever you're in a situation like that, one of the things that, my lawyers don't like it when I say the word liquidity, but it's something that is a very real thing especially when you're talking about something like this, right? The setup that you give is like, no one talked about this thing, and then the stock's up 150%, and the implied move is 19% for earnings. It's like, okay, well, let's say you forecast a certain thing and you put the right option position on and you're right. Like, what does it look like to get out when that happens, right? Like, what the liquidity provisions are real when you're talking about something like that. And it's something that you have to build into the way that you think about your positions, because you can't just enter a position and then never expect to take it off, right? Yeah. I mean, the whole idea of putting something like that on is the fact that you're actually able to take it off, especially if you're right, or God forbid you're wrong, right? Like, how do you, and so I mean, when I was market making, especially in single name stocks, I was always looking at obviously just the overall, implied volatility level of the straddle, but then I was also looking at the wings, right? Both sides of the wings. What does that look like relative to historical norms for something like this? Mm-hmm. I think whenever things get this elevated, there's always something in there that's probably just mispriced, you know, from a theoretical perspective. And that's the way that I would always look at a situation like this, is I would always look at call skew versus at the money levels, right? I would look at that like 50 delta, 25 delta call skew. And I would always express it as a ratio, one over the other. And then look at the, the ratio of those two implied vols. And then I would also do the same thing on the put side. And that gives you a good idea of, because what that does is it takes into account the fact that the implied level of the at the money is elevated. And then you can look at like, okay, well, what does it look like for the 25 delta options on either side relative to the elevated straddle level, right?
Yeah, so just to cover a couple of those data points you mentioned, we have this thing called skew rank, which obviously ranks, what this does is it ranks the 25 delta call versus the 25 delta put, the implied vol there. So interestingly here, it's kind of been a little bit noisy. The skew rank was really low, and now into earnings we see it's very high. And so, the implied vol rank into earnings obviously is very elevated. But here's the difference between 1 month realized vol and 1 month implied. That spread doesn't catch me as very wide, as you can kind of see there. So I guess the thing that jumped off the page when you just mentioned that was that skew rank is really elevated. And then when we look at the volatility dashboard here, we can look at a few different things, but but here's the 1 month skew versus the last 90 days is that spread. So I think the implied vol's come down a little bit, but that's from probably the highs that were associated with this peak in here, I'm guessing. And so there's
Let me ask you a question.
yeah.
When that skew rank is 0.75, is that saying that it's high puts are higher than
No,
calls,
the other way,
or
calls
the other way
over
around?
calls over puts in our metrics,
Okay,
yeah,
I figured.
in this
Okay.
metric, yeah. So, you know, the other thing you just mentioned was the skew premium. So in this fixed strike vol matrix, this just shows the statistically well, fixed strike vol, obviously with the expirations, and I put this in skew mode, skew premium mode. And the thing that jumps out when you mentioned what you were talking about, what was how rich this call skew is. And then you look at that skew rank of 75 to 90%, depending yesterday versus today. And that tells you that people seem to be bracing for some kind of giant number coming out of HIMS tonight. And I don't know anything about the stock. You look at the straddle right now, straddle's going for about $10, Friday's straddle. But these skews up here show just what looks like really rich skew premium. And so the way that I generally talk about this, and I would love for you to just dunk all over this, or maybe you're going to tell me this is super smart. I don't know. But I look at this and I go, if there is a trade to be had here, I personally would want to bet on mean reversion here, and then maybe structure something that takes advantage or assumes that call skew normalizes or comes back in line is the trade that I would think about structuring in this case. And I understand from your compliance department probably won't let you say, yes, definitely do that. But maybe you say that doesn't make sense to me, or maybe say, hey, Brent, that does possibly make sense, and here's how you could structure a trade, to take advantage of that.
I think it does. I mean, saying something like that obviously does make sense, especially when you look at metrics that you have up on the screen right now. The thing that I think is interesting, I was a relative value trader, and so I always look at things in relative value terms, which means when I'm looking at call skew that looks juiced, there's a part of it that I always think, okay, how much of this is just the fact that the straddle is juiced, right, overall, and how much of that are we seeing in the put side as well? And so that's the reason why I always I said before, I would look at the ratio of the at the money vol divided by the 25 delta call vol. And what that does is it gives you a ratio of like, what do the calls look like even though the straddle is juiced? And then you can do the same thing on the put side. What does the actual 25 delta put look like as a function of the at the money vol? And then you get not only the actual, okay, so now I know what the wings look like relative to the at the money vol, and then you can also look at what you just pulled up, which is just the call versus the put, the 25 delta. And all you're really doing there is looking at the ratio of those two vols anyway, right? And so what you're really doing when you look at it in that relative value context is just adding in the extra step, which is, oh yeah, and the straddle is roofed, right? So like, what are we going to, how much of that is in the call, how much of that is in the put? But if you're looking for, right, one of the ways that for a while I was also a broker. And you obviously know, I think your side was, you were on the institutional side for a long time. And clients would always want to trade risk reversals, right, in those situations. One of the ways that I think it's the ratio spreads are always a way that you can think about trading skew. There's no better way, there's no more aggressive way to get exposure to skew than doing ratio trades that are buying or selling wings more than you're buying the at the money, right? And so like call 1x2s, things like that. Yeah, exactly what you're saying there. So you would, some people like to, in the case where you think that the actual call skew is going to come down relative to the ats, you would do things like call 1x2s, buying the 50 delta, selling the 25 delta call twice, and have a 1x2 on. Oftentimes you can do that for very low premium because when the calls get juiced like that they're so high relative to the at the money that those 1x2s actually collapse in price terms when vol goes through the roof, right? So
Yeah, I have an interesting anecdote about that. I was in one by twos this way in Palantir,
yeah,
which did not felt good up until last week, and then suddenly it felt really good.
yeah,
And the reason is because the stock, when you are in the one by two, and you think you're smart because like Brent and Palantir, or if you're in HIMS and you put that trade on here, and the stock does that, that doesn't work out very good. But to your
yeah.
point, if you time it right and that wing collapses, then this trade does very well. Now, the thing about this trade, I would love for you to break this down a little bit more than one by two. A lot of times when people put it on, they do it delta neutral, right? So they may put on, and correct me if I'm, please, any of this stuff, again, dunk on me if I'm wrong, but
Yeah.
we'll do the 50 delta call versus say, and then sell 225 delta calls to make it a delta neutral structure. But generally what you're going to trade here, you're trying to trade here is the volatility collapse more than the price collapse. Is that right?
Yes, I mean, if you're trading it for that reason and you're doing it from a premium theoretically neutral perspective, or a delta neutral perspective, or both, really what you're looking for is, as long as the move isn't an outsized move that takes you into a delta territory that is going to hurt, like what you're talking about, the Palantir situation, what you're trading is you're looking for the actual vol dispersion to come right to relax, as it were. But I think where you're going with this is that when vol inevitably does relax like that, that the trade that you originally had on that was delta neutral is no longer necessarily delta neutral, right?
Yeah, and I suppose the other thing I'm trying to get at too is there's a difference in this situation, with him, like, so like right now, HIMS, obviously, the earnings event is going to come off, and that should reduce volatility, implied vols, right? So there's two things, and I think this people get tripped up sometimes with this. Number one is I think the stock is overbought and I want it to come down. Or the second one is, hey, implied vols at 150, the earnings move $20 or whatever, and that skew premium is really rich, and I want to tap that skew premium, which is arguably a different trade than betting that the stock is going to go down, right? And so
Absolutely.
I think when you go to structure the one by two, you have to be careful because you could arguably think you're betting that the stock's going to come down, but you're actually short vol, or you're actually placing a bet that the stock's going to come down, but you're not that short vol, right? And that depends on the tenor of the trade and how that strike is, those strikes are positioned.
Yeah. There's another point that I think you bring in, which is really interesting. When you're talking about the tenor of the trade, the duration of the option that you have on is going to actually make a big difference in the risk profile of how those positions, you could have the exact same call one by two on in a 20-day option as opposed to a 90-day option, get the exact same move, and one of them might make way more money than the other one, and it might not be the one that you think is going to, because of the fact that those options, their relative durations implies a much larger amount of vega sensitivity in the longer term option, which means if implied vols do come down, that the price of that one by two is going to change by a lot more probably than the one in the front if there's not a massive move, because the move itself, and when I say move, I mean move in the underlying, the move itself is going to affect the options that are gamma and delta sensitive, which are going to be further up in the curve, right? And so right, you always see this when we're talking about how duration, how the vol curve looks when you see situations like this. And the reason why is because those vols, the duration curve, right, the shape of it, they get jacked in the front usually because of the fact that people are expecting moves like that. And that's where the actual gamma options are most centered, is up front. And so pay attention, right, to the duration that you're talking about. One of them is going to have a lot of vega, one of them is going to have a lot of gamma, and you might be looking for a mixture of both of those, and you're going to find that somewhere in between those as far as duration is concerned, right?
Right. That was very very well put. And so the general way that I think of it, and most of the people in this group, I would consider a mix of some institutional traders in here as well as pro tail. I like to call them, call us, whatever. But when you want to short this skew, you probably want to go out farther in time, right? Because because particularly with the earnings event, right? And the idea is that you're getting more, short Vega. The earnings is going to come off. That's going to drop that vol, and then when we go farther out in time, we're getting a little more of that Vega as opposed to a directional price play. Is that the right way to think of it? And then if I actually wanted to short Vega in this type of a structure, what is the minimum I need to go out? Is it 3 months, 6 months? What is a rule of thumb you'd want to think about?
I mean, I tend not to give rules of thumb in that situation, but I think, traditionally the 1 month options and further and closer to expiration at the front of the curve are where a lot of that gamma is. And then when you get into like, the way I used to break it down when I was trading is I would think about the 30-day bucket, the 90-day bucket, and then beyond, right? And that was kind of how I looked at where the mixture of gamma and Vega really was. Of course, if you really want to get granular about it, you can look at, obviously there's so many different gradations of expiration now, especially in options like this, that you can get pretty granular up front. But then there's just, right, every 30 days, generally speaking, with options like this, you're going to have an expiration, and you can look at how the term structure lines up per month, right? Each month is going to have its own tenor and its own mixture of gamma and Vega. I think it's interesting when you're talking about like, maybe the best place to trade this is to go further back if you're looking to capitalize on the skew. There's a part of that I also think, right, from a market making perspective, when you're dialing curves around, when you're just reacting to the flow, you have to make a decision as to, okay, there's a ton of call buying in the front of the curve. How much of that I'm seeing actively and that is really happening and it's priced there, am I going to allow to influence what the skew looks like that's like 90 days later, right? And we used to call that leak, right? It's kind of like the calls will go crazy bid in the front of the curve and then it leaks back into the farther out curves, and right, the calls will go bid, but they might not go as bid as you go farther back, because if you think about it, if you're moving calls the same amount on a 90-day option as you are on a 30-day option that has twice as much, 3 times as much Vega in it, you're saying something different about what that option means from a market making perspective, right? A movement of that amplitude in a 90-day option is saying essentially, I expect this to be there for 90 days. And that might not be the case, or it might be the case, but when you look at what the duration looks like and what the actual, the curvature looks like over the course of the duration, you have to expect that some of those moves, as far as skew is concerned, are going to be more muted in the back of the curve than they are in the front of the curve because of that very fact.
That's a great point, particularly in these names that are so retail heavy, where so much we get focused on now is like the 0 DTE or the shortest dated option. There's so much activity taking place there that can really juice the short term options much more, and that term leak is an interesting one. And the question someone just put in here, they're anonymous, so I can't name them. How do you automate those calculations for ratio spreads to evaluate wing premium? You're the investor pro, so take that one, please.
How would I automate what's the question?
I don't know. How do you automate those calculations for ratio spreads to evaluate wing premium? So, when we, I'll just state this, like we have this tool called skew premium, and all this is doing is it's assuming that all options are trading at the same implied vol, the at the money vol, and then we see how much skew premium is in there. And so there's this kind of interesting shape, where you could see the longer you go out, the premium kind of moves up, kind of in accordance, I guess, and there's a more eloquent word for that, but you get the idea. And so, this is the area where I want to try to sell these options, right? So, this is the structure that I want to sell is the richest premium. Now, the farther you go out in time, that doesn't always, so like when I think about this, like I don't always necessarily want to go delta neutral. Sometimes I maybe want to do it for, I'm evaluating the amount of premium I'm putting on, some different structures like that. But what, so we talked about doing this delta neutral. Is there another way you possibly want to structure it? When you're thinking about putting a trade on, let's say 2 months out or 3 months out.
Yeah. Let me say one thing to the automation side of things. Obviously, the tools that SpotGamma has are going to help you with that. There's another way that you can think about it, though, and monitor it. And that is, and this is always kind of the case when you're thinking about it from a relative value context, is think about like, okay, I want to look at the 50 delta, 25 delta call 1x2 that has 30 days to expiration in it. And I want to look at it every single day, right? The same. And what you have to do when you look at something like that is you have to take out all of the kind of the variable parts of it that aren't easily replicatable on a daily basis. And so that means focusing on things like delta instead of strike, right? Like I want to look at the 50 delta, 25 delta call spread, or the 50 delta, 25 delta call 1x2, because it's like generic and it gives you a way to be able to look at the same thing every single day. And then what I used to do, to be honest with you, is I would import prices 5 times a day automatically and feed it into a macro. And then it would spit out, the price of that thing of the 30-day 1x2, right? And I would just look at it and see like, oh, okay, vol's getting crazy juiced. And this 1x2, I've never seen this 1x2 under $1.50. And now it's trading for 90 cents. Things like that. And that can sometimes give you just kind of signals to be able to look at something like that and say, oh, that means either the vol is getting super juiced or the calls are getting super juiced, right? And that, because that's the only way that this call 1x2 goes down by that much in price. And the only way you can look at that is if you look at it every single day, right? You look at the same delta call 1x2 every single day, and you have it kind of tattooed in your brain as to like, what does that thing generally trade for?
Yeah.
And so that's kind of how I would, if you're looking for ways to automate it, you're not technically like automating it, but you're kind of like, it's kind of like a hack to automate it in some ways, right?
Yeah. I was just looking at Thinkorswim because they have, or I guess it's Schwab now, whatever. They allow you to change your options montage to be call spreads and put spreads, but I couldn't tell what so I have a ratio in there, but I don't know what the ratio actually.
It just says call ratio.
Just says ratio. I think I have to get into the settings, which will distract me.
Yeah.
I'm easily distracted, so I gotta stay away from that.
It's probably it's probably something just like that, right? It does the delta. It allows you to monitor the delta call 1x2 or 1x3 or 1x2.5 or whatever you want to do. Yeah. And then I would guess if they're smart from an execution perspective, they have a direct link from that to be able to quote it and execute it on their platform, right? Like, go ahead, right here, the 1x2.5.
I'm sure they do. Tasty I'm sure. I found that 1x2s are interesting too. If I when a stock is crashing and the put wing really blows out, sometimes you think it's like, hey, the move is just overdone, I don't want to short that vol, but you can play with the strikes because maybe I'm like, well, I kind of want to stay short this stock, even though I think the move is like overdone. I don't think it's going to bounce much. So you can adjust those strikes a lot and play with them to really express a variety of ideas, which I think is cool. And the other thing I'll leave is that there are times, like we talked a lot about this during Tesla when Trump was elected, and I wrote a whole article about this and was like, hey, I don't think that the market is pricing in a big enough move to the upside, could be also the downside. So how do I play that put skew or call skew blowing out and expanding? Like, how do you catch this HIMS move before it happens? Well, 1x2s can be an amazing way to structure those trades as well. If you think that call wing isn't being, or put wing isn't being priced at a high enough level. So a lot of variability. And then last but not least, the OCC would appreciate if we said, you can also add a very cheap, far out of the money option to hedge yourself to make sure that you don't get nuked.
Guess what? Now you've got a butterfly on, even if it's a tilted butterfly. Being unit neutral is never something that I'm going to tell someone not to do. Being unit neutral is a great way to cover your proverbial backside.
Yeah, so compliance, ching ding ding, we did it. We checked that box.
Bravo. One thing I will say though, hey Brent, one thing I want to say is also when you're looking at the different sides of the distribution, the calls and the put sides, the thing that we always used to talk about when we were making markets in the SPX is that sometimes the most bullish trades, sometimes the thing that, when you're a market maker, you're always trying to kind of like read the tea leaves of the flow. And I get the feeling that a lot of people like to do that or try to do that. And sometimes the most bullish trades were people buying puts, right? Like I would walk in and it wasn't always like big fat 40 delta puts. It was like, this guy just bought 75,000 of the 12 delta put. And I was like, and then, every once in a while it would be like, oh, and now there's all these other people buying puts, and now there's all these other people buying puts. And sometimes the reason why they're buying those tiny little puts is because they're buying futures, right? And if you think about it, when you think about it from just a put call parity perspective, buying tiny puts and futures or tiny puts and stock is essentially the equivalent to buying that same call, the in the money call. And so if you are looking for ways to structure trades that aren't necessarily on the same side as like everything that you're seeing from a flow perspective, but you want to potentially create a bullish trade that doesn't just buy calls like those people do, or like whoever does, that it can be a really interesting way to think about that, right? Like you don't have to just concentrate on the call side in order to be bullish.
So you mean sell the puts as a way to express the bullish upside?
Or in situations where things get crazy cheap to the downside, right? When the puts are, like zero, basically, you can buy puts and stock and have them,
okay.
right? Puts and stock is oftentimes more bullish than, buying calls, because you're buying theoretically a discounted vol and, a theoretically discounted vol, and you're buying the underlying. And you're still involving the optionality. You're still involving the leverage. You're still, right? Like don't ever convince yourself that you're not trading vol, because you are trading vol in some way, shape, or form. But it doesn't, like I always used to try to think about, like, everyone's looking at this shiny thing over here. That means that oftentimes there's something over here that's being ignored, or that's being priced incorrectly or something, right? I think it's something that people can build into the way they think about the matrix in general.
That makes sense. So that was the put call parity piece, was the owning futures and buying the puts. So that makes
yeah, exactly. Sorry if I wasn't clear about that.
No. I jumbled that up. Pretty quiet flow, I would say, in HIMS. I was looking to hopefully see that this largest trades of the day thing would be packed with HIMS trades, and then we would have something to talk about there.
To actually pull up and look at.
I wanted to. Well, I got two interesting things that I wanted to talk about. One is a little bit of curveball about dispersion. And are you familiar with the CBOE dispersion index at all?
I am. Yeah, I haven't I mean, I can't trade it, but I haven't traded it. It's an interesting. I know that they are all in on these derivative products and have more, and have just like a constant pipeline of them coming.
Yeah. So the thing that's most interesting to me, I guess, about and this is their correlation, metric, which measures in the top 50 S&P 500 stocks, it measures the implied vol of those options versus the S&P options. And so the thing that I think is interesting about NVIDIA is maybe not trying to trade NVIDIA itself. I mean, I suppose there's a few people that are obviously here, more than a few, that are interested in trading that. But what I'm curious about is when you look at something like NVIDIA, it has. So just to get an idea of the implied move here, I just have to open this up to do that. It has about a 7% implied move. And when you look at the S&P term structure, and this is where the question I have is coming back from a kind of a market making perspective here. You have a name like NVIDIA where I think the whole market is watching this thing, very closely. And so this is the SPX term structure. And this is the term structure due to, yes, GDP is out on Thursday, I think it is, and we have PCE on Friday. But I think that there's this kink in the SPX term structure for NVIDIA. And, you were mentioning before, you understand vols when you watch them every single day, and I just basically watch SPX every single day. And so I believe that this is strongly, impacted by NVIDIA earnings, right? And so, what do you start to think about this where there's this single stock that can move, the index vols? Is there a different way you got to break that analysis down? Or how do you think about trading in the S&P when you have, a single kind of idiosyncratic risk, I guess, like a single stock earnings?
Yeah, that's it. I mean, that's such a, I kind of feel like this is the question of the next 5 to 10 years. I mean, and the reason why is because if you follow the way that people like Michael Green talk about, how passive investing has changed the landscape of the way that people invest, you see it. What you're talking about here, what you're pointing at here, is a very good way that you can see that actually like the rubber hitting the road, right? Which is this is an index, and it is this wide kind of it's supposed to represent the entire market. But when you get into a situation where things are so concentrated, it ends up being a proxy more of those things than it is of this widely dispersed index. There's not a lot I can really say about that other
It's
than
a very tricky question, so I don't.
it is a
put you on
tricky
the spot
question.
with a lot of curveballs at once.
Well, it's just something that you have to keep your finger on the pulse of that, because it's very real, right? It's very real. When you're talking about concentration in 7 stocks as part of the S&P 500, as tilted as it is, it becomes, a thing. And Michael Green's point is, when everyone continues to pile into that trade over and over again because they just can't not do it, because as a function of how they invest, right? Buying the S&P means buying an ETF that replicates it, or buying something that goes out and then buys some replication of those 7 stocks in some percentage. What you end up with is just flow that ends up in that direction. What happens when everyone tries to go the opposite direction at the same time? Right. I mean, that's an issue. I mean,
yeah, 100%. And I think the other thing about this is that we have a lot of people here who only trade futures. They actually don't trade a lot of options.
Okay.
Number one, how dare you all? But number two, it's interesting that they like to watch the market. And I think that you could sit in this bucket where you're like, I just trade the S&P, and so I don't need to watch these single stocks anymore. And I think that is, I don't know about it's increasingly untrue. It feels more increasingly untrue that you can make that statement that, hey, I don't have to care about, why do I care about NVIDIA earnings? You make the argument, you look at these S&P vols, you go, well, this is saying that S&P cares, and if you trade E-mini futures, you should care because the S&P cares.
Yeah. Yeah, I think it's real, right? I mean, that's very real, and it's a very real part of the landscape. I have that same question when people ask me, why should I care about implied vol? I trade directionally. Why should I care about implied vol? And my point is always well, even if you're trading directionally, if you're trading options, you're trading vol. If you're not hedging it in the same way that the other person is hedging it, you might not be trading the exact same vol, but you're trading vol, and your implied vol is part of your P&L. Even if it's just a part of the P&L that you didn't fully realize because there was a part of the P&L that came out because the vol came down, but you were right on the move, right? You're still trading vol. And so I think that's the most important part. And that can be, you can apply that to not only what I just said about you're always trading vol, but also to exactly what you said, which is if the S&P cares about it, it's going to filter into some amount of your trading. How much of it filters into, that's hard to say. That's up to you to figure out and how you want to express it, but it's there, and it's real.
Yeah. Do you know Tom Jark? City. You guys probably crossed paths at some point. He used to be head of the city derivatives desk. And he was at the MIAX, and I unfortunately forgot where he went. But he said to us in a session like this once, he's like, once you have a trade on, you have fixed strike vol risk, and that always sunk with me, and it kind of matches up with what you're saying.
Yeah.
And I think a lot of people are like, oh, that's so true. That the vol of that option is really what you're carrying, that you care about, and you have to watch. And I suspect a lot of people look at that premium price a lot more than they do necessarily the vol that they're trading in the specific name.
Yeah.
It's kind of
Absolutely.
I wanted to pivot to something, and I gave you a heads up that I was going to pivot to this, but I don't think that there's a condor trade on right now. But there is somebody or somebody's, there's an entity that likes to come out and trade technically one DTE condors. So these are zero DTE generally it's a zero DTE condor.
Okay.
And when they come into the market, you had mentioned you weren't terribly familiar with this trade, so I'll just describe some parameters. But they will put on, usually it starts around 1,000 lot in the SPX, and they put it on at 4 o'clock p.m., somewhere between 4 and 4:15 p.m. for the next day expiration. So that's why I call it one DTE, but it's really zero DTE.
Okay.
And so what happens with this person, I've gone back through and I've tried to identify every trade that they've done over the last, since July of last year, right? They have a 58% win rate. So it's not that great of a win rate. It's a $5 wide SPX spread. So typically the trade goes on for $1.75 maybe. So that's the premium they collect. So they lose $3.25 when they're wrong. Yep. And they're only right 58% of the time. One of the things that frustrates me, there's another part of this trade I'll explain next, but the reason I bring this up with you is because, number one, how do you think about when the optimal time to put condor spreads on is, or that similar type of trade, particularly if you're going to trade like a zero DTE, which is really, I think, can be quite tricky. So, what is like the optimal situation to put on a condor like that? And then how do you think about negatively skewed payouts versus positively skewed payouts? I think so many people love this idea of like 80% of the time I'm right, I collect my nickel. And then those other, the 20% of the time you're wrong, you just get,
right. I lose my entire year. Yeah.
So the way that this just, and the way that this person gets out is they run this martingale strategy. So if they're wrong, the next day they double their size. And then they double their size again. So this position where it's normally 1,000 to 2,000 has gotten as big as 50,000 contracts, which is very large.
On a one DTE condor?
Yes, yeah. That's happened about 10 times. That's been over 10,000. So you start to get into this game theory kind of situation where you go like, and this is going to be my second part of your question is like, why wouldn't the market maker in that situation know who guy is? Because they come in pretty consistently and then just jam the market against them if given the opportunity. Particularly at a 50,000 lot, you would start to think they have more of an incentive. So anyways, condor structuring and negatively skewed payouts would be the first thing that I had these questions about. And when you talk about investor education, I'm just curious about what your thoughts are on that, because I think it's a trap a lot of people get caught in. Yeah.
Oh man, yeah. I mean, there's a lot that as people say in the podcast world, there's a lot to unpack there. So a quick story just to give you that, and this is different because it gives you the fact that it's a 1-day option trade or a 0-day option trade has its own kind of like asymptotic, right, like relationship to the end, quote unquote, of the trade. Because it's only a 24-hour trade, but someone can double their size as long as they want, only insofar as they're still in charge of their own account, right? That's number one. Number two, like a quick story, in 2008, there was a guy who used to sell strangles in the S&P, and he would sell strangles like every 3 days, and it got to the point where he won so many times that his size got so big that we all started, this was like 2008. We were like keeping track of it on skew cards to know, right, what strikes the guy had on. Oftentimes it was so big that all you had to do was look at your actual inventory and you could tell what strikes he had on.
Yeah.
And so when they would come in to quote it, we would, always fade it. We were market makers. And so we would fade it, but you could never fade it enough for it to actually be a good trade, right up until the point where it was very obvious on one morning that we had gone through his upside strike the night before, And now we were through his downside strike. And he was short both of those strikes. And the person who was on the phone on the other side of the broker phone was not that guy anymore, right? It was a bank guy who that guy was not in control of his position anymore, right? And so doubling your size is, from a game theory perspective, sure, yes, if it doesn't work and you double and, up until a certain point, but when someone steps in and says, okay, you're not in charge anymore, now the bank owns your position, you don't get to make a decision as to whether or not you double your size. Now, the interesting part about this is that it's a one-day trade. So chances of that happening, who knows, but they're probably less than the situation I described, but it's still a possibility, right? The secondary thing is there's always a mix of 80% of the time I make a nickel and 20% of the time I, get my face ripped off, to 20% of the time I make $1.50 and 80% of the time I lose 40 cents, right? Like the mix of those two things is the art of what you're trying to kind of do. And from my perspective, I can't tell you that like there's one right way to do this. What I can say is don't ever be swayed by someone who's going to tell you that like 87% of the time their strategy works. And that, right? I mean, listen, I used to say that all the time, and now I say it even more because anytime I go onto the internet, it is rife with people pitching that exact thing, right? This works 85% of the time, and I'm up 300 grand in 7 days, right? It's like, okay, yeah, I mean, sure, guy, way to go. But I think if you're looking at it in those terms, you might be looking at the wrong thing, right? If you're looking for someone to tell you that, you're looking for the wrong thing. You're not approaching it in a way that's going to be long-term, right? Like,
it's
tenable, right?
It's fragile, and the way I've tried to think about this too is if you do that in blackjack or roulette or whatever, at some point the casino boss comes out and says, you can't do this anymore, right?
Yeah, you're done.
You can't keep doubling, you're done. Even if you still have the payroll to keep going. And I think that would be the same thing with zero DT. Is like, can that person double that trade from 50,000 to 100,000? You start talking about 10, 20, 30 million dollars, 40 million dollars worth of premium, which, okay, if you're a giant hedge fund, maybe you got that kind of role, but average retail guy, maybe not, if that's, who this is. Sometimes it's hard to identify the trade, but this is what the trade looks like here. This is the call spread. This is today. And then this is the put spread. I believe that's the trade. It's a little bit smaller today, so it's a little bit hard to focus, but you'll oftentimes see the market hit the area where the zero DT spread is, and then it will oftentimes mean revert. And I guess the thing that was surprising to me is from that, again, game theory perspective is, someone like you sitting there and you're going like, all right, this guy comes in every other week when, these are the parameters, this is them, I know who they are.
Yeah.
He's not going to be dynamically hedging this thing to $5 wide condor, it doesn't make whatever. And I make 10 million bucks if I just buy enough futures to push this through that strike. I mean, the reason I ask this is because the last few times where I was like, this is the odd thing that to me seems like it makes sense, it doesn't happen, right? And if the person is who I think it is, they're not selling futures trying to protect this spread. I mean, again, it's $5 wide. Like, it doesn't really necessarily make sense to dynamically hedge that thing to me.
Right.
So, I mean, why wouldn't a market maker try to push the market up through those strikes? Or not even a market maker, just someone on the other side of these trades, right? I mean,
well, I think the answer to that question is a market maker who's operating in any size like this is busy doing 75 million other things, and making a delta trade of that size just to push it through a strike is going to be hard to explain to your boss when you lost like 3 million bucks on SPOOs that you didn't need to buy or you didn't need to sell, right? I mean, think about this. The people who are the largest quote unquote institutional traders of the other side of this spread are the people who are making size up markets in the 1DTE options, are the big market making firms in Chicago that we all know, or the Netherlands, or wherever they are, right? I mean, We all know who those people are. I worked at one of those places for a while. It's not beyond the scope of your ability to make that decision as someone who's head of desk of the S&P's options. You could, if you wanted to, say, sell 10,000 spoos. Let's push this guy and see what he does.
Yeah.
But you got so many other things going on.
That's what, who am I to argue that, your point, and I think 99% of the time, like, I totally understand your point, man. But when it's like the 50,000, I'm like, maybe but the interesting point here by whoever T is, they say market makers are delta neutral, and this is the interesting point he says, is they do not care who's on the other side of the trade. Do you think that's true, that they don't care who's on the other side of the trade?
I mean, that's a really good question. I think
I can tell you the upstairs guys really care who's on the other side of the trade.
Well, the upstairs guys really
who
care.
Don't get a phone call back.
Yeah, the upstairs guys really care who's on the other side of the trade because they have the capability to keep track of it, and they care who the clients are, right? I mean, the institutional guys care who's on the other side of the trade because they want the flow, right? They want to know who it is, and they want the flow. Let me tell you this, from a market making perspective, if you're standing in the S&P making option markets, your job is no longer to care who's on the other side of the trade. It used to be in 2005, 6, 7, 8, when I was doing it. Yes, we cared, and we cared who was on the other side, especially once you got into very large trades that everyone knew when they were coming to get out, right? Mm-hmm. Because if you didn't know to skew the market the right direction, your friend who you had lunch with was like elbowing you in the side when you were telling everyone you were too half bid, when the whole crowd is like, no, that thing's too bid at a half, because everyone knew he was coming to sell it, right? I mean, that is not a part of the landscape anymore as much as it used to be. And so I don't think people who are making markets like that care anymore, because there's so much flow, especially in the zero DTE stuff. There's just so much just floating around that it oftentimes doesn't matter as much. But when you're talking about a trade of this size, when you're doubling every day, it starts to matter. I mean, market makers care who's on the other side. I mean, there's no way around that. Right. You kind of have to, because your job is to maximize the flow, right? The flow is coming. Try to make as much out of it as you can. And you can do that in lots of creative ways.
And I'm not asking you to comment on this next statement, but this is also why payment for order flow exists.
Hey-o.
That's the pen drop. All right, Matt is
hands off on that one, Brent. Hands off from my.
If they didn't care, if they didn't care, then that wouldn't be a thing.
Okay, that's fair enough. I'll say fair enough.
All right, let me fire through a couple of these questions here. People seem to really like when you come on and talk a lot more than when I talk. Maybe I talk in general just to myself.
People, I mean, there's no getting around it. People like stories from the like 1998 to 2010 floor days. It's part of I've learned that over time.
Yeah. All right, so a couple of questions here, and I think just some general things to think about when you are putting on some trades. So Justin Goodman, he's one of the SpotGamma OGs around here. He asked about the idea that Microsoft options look cheap, and I think that is also something I've said recently. So I will just say, unless something changed drastically, I will agree with him. When you are trying to teach someone or educate somebody about, hey, these options are, cheap or they're expensive. Let's just say, for the sake of Microsoft, that we think they're cheap. I'll add some stats on here and we'll just take a quick look. So, all right, so this is the range. It looks like these kind of 20 delta calls are in that neighborhood. Let's just say you agree that they're kind of cheap. how do you break down, you say, okay, I think I want some upside exposure in this name. What is kind of the checklist that somebody like me or you know, one of the people on here can go through to say, this is the thing I want to think about in terms of structuring my trade, you know, this is the tenor I should go with because those are cheaper. I should do a call spread instead of an outright call. You know, what's kind of the quick, you know, finger in the air checklist you can go through to.
Oftentimes, the way that I would look at it is that I would look at that. Bloomberg used to have a fantastic duration tool that you could look at the three-dimensional vol surface, right, for the entire thing. And if, let's say you're looking at something and you're like, the calls are cheap. Okay. First of all, like, it's really hard for me to use words like cheap or expensive because of regulatory whatever. So you might hear me use substituted words for that. But number one is I always needed, from a trading perspective, a benchmark to compare it to. Like I said at the beginning, I was a relative value guy. So for me, it was always like cheap compared to what, right? What are they cheap compared to? Are they cheap compared to their historical perspective? Are they cheap compared to all of the other, you know, members of that sector? What does it look like relative to all the other, you know, giant, you know, like software companies, or, you know, Coke calls versus Pepsi calls, you know, things of that nature. What are they cheap relative to? Because there's always something in there that's like, are they cheap? I don't know. If nothing happens, then nothing is really cheap. It's all expensive. And so oftentimes I would look at things like I said at the beginning, which is the call spread, right? The calls relative to the at the money calls, the 25 delta calls relative to the at the money calls. What that does is it gives you an idea of, instead of just looking at something and saying like, oh, it's only worth 30 cents, it's cheap. It gives you an idea to be able to say, oh, it's only worth 30 cents and the straddle is $6.50, right? Like those things, there's a big difference between a 30-cent call and a $6.50 straddle and a 30-cent call and a $4 straddle, right? If you're talking about the same duration. And so that's what I would always advise people to do, is have some sort of context to be able to evaluate it. And whether that context is historical within the actual name itself, or within the sector, or, you know, but you need to have some sort of ability to like pull the actual data out of it and make it less about like, oh, it's only worth 30 cents, and more about like, what is it worth relative to the rest of the curve? And that's part of the reason why I love looking at that three-dimensional skew representation, right? It gives you an idea of what the whole surface looks like. What kind of vols are we talking about in a 30-day option versus what kind of vols are we talking about for that same exact strike that only has 12 days left in it, right? Like, what do those two things look like? And sometimes the answer is trade the time spread, right? Sometimes that's the answer. Yes, those calls are cheap theoretically, but they're cheap relative to the 30-day call, right? And so if you trade the time spread, what you end up having is, not only are you long the call that you think is cheap, you might also be short the call that you think is expensive, right? And that's like one of those things that you can actually build in when you're talking about time spreads or things like that. So that's an alternative way to think about it, right? You don't just have to go in and buy the call you think is cheap, or the put you think is cheap, or sell the one you think it's expensive. It can be that relative to something else.
So in order to decide that you really want to put on the call versus the call spread, we generally like to look at skew as a barometer for whether you should put on the call spread versus the call. But what we're really saying is you really have to evaluate the entire surface in a way to sort of normalize where we currently are.
Yes. I like that. That word is a great word, right? Like the normalization of like, where are we relative to historical norms, and where are we within the entire spectrum of like where all the calls are, right? I mean, it's hard. Sometimes it's hard because you know, a lot of people, and I even ran into this especially towards the end of my market making career. I used to make a joke on the trading desk that was, and this was a function of the fact that the bid-ask spread was getting so tight that I felt like there was no difference between the where we would buy options and where we would sell options anymore. And so my joke was always just pick a side and do them all, right? Which is like and it's not a particularly useful insight into trading strategy, but what it is a kind of a way to poke fun at the fact that we all think that we're getting some sort of massive amount of edge because we're trading this call for a nickel relative to our theoretical value, or a penny relative to our theoretical value. But you might as well just buy it or sell it or just do them all, right? Like to me, it was like, I don't know, like there's no difference between where I'm buying it and where I'm selling it anymore. And that, I mean, right. And that, that's not a serious way to approach trading, but it is certainly it was a response to the fact that sometimes it doesn't matter how complicated you make things, that like, it's just like, do you have the right strike on? And if you do, you win. And if you don't, you lose,
Right.
I mean, like sometimes it's as simple as that too.
Yeah. I take the points interesting. And I think the normalization thing is why we try to put, these ranks in, because the ranks just, and this is not for you, Matt, but for other people listening, the ranks are each individual stock's implied vol, right? That's what we show those. So it's like IV rank. You can't take IV rank for NVDA and use that, obviously, or you can't compare NVIDIA to S&P directly, right? The two aren't the same thing. So we give the individual ranks for the individual stocks, which I think everyone knows, but just making sure that's clear. And I think my takeaway from this conversation is let's add a few more tenors in there, maybe, which can help people. And I know Blue's floating around in here. He's been one of our members and part of the team here that he pounded the table on wanting to call skew and put skew separately, which is about a month out. So that's for you, Blue. Because I can hear our conversation after this when he's like, see what Matt said? I told you so. And I was like, that's fine.
Well, I mean, when I first came to OCC, I did an entire presentation on like relative value and how I used to look at relative value, call spreads versus put spreads and skew ratios and things of that nature. And what I realized very quickly was that most of that goes right over people's heads, right? Because it is a relatively complex way to think about it, even though from a market making perspective, I thought it was like the most simplistic, beautiful way to express whether or not call skew or put skew is rich relative to historical norms, right? But you also have to kind of like dial yourself back a little bit and be like, not everyone is not everyone is making prices in 300 stocks all day long, right? Most people are like trading call spreads for earnings or whatever they're doing, right? And so you have to kind of like dial it down to an even more distilled version of that. But there is some kernel of truth into how you look at things like that in vol terms, in vol ratio terms, that you can distill down into something that people might be able to use. And I think that's important. It sounds like that's what you guys are doing.
Yeah, to your point, a lot of people want to go where the action is as opposed to all day, every day, and all 300 names. And so to be able to kind of put that in context. I got one last question. I want to be aware of the time. You've been very gracious here with this last hour. This is from the aforementioned Blue. So, do market makers embrace a positive or negative gamma/vega drift overnight, given that they prioritize flattening the deltas and they know how to make money in both regimes? So that question was a mouthful. You can tell Blue likes the tough question.
Do they embrace it? Like, what does it mean? Do they embrace it? I think that it's foisted upon them, essentially. I mean, it's not Blue. It's not something that from a market making perspective, you have a choice in. You just kind of have to, as you are bombarded with these positions through the flow, so much of market making is actually like management of delta, right? Management of delta drift and management of, charm and things like that. And as we become more sophisticated in how we think about Greeks, it becomes much more of that as people start to understand it better. But like, if you're holding, let's say you're holding, you have a very concentrated short call position that's out of the money and you're long futures or stock against it. And that is like the majority of your position. Or you have lots of other positions, but like you've got this 10,000 lot of calls. That's like a 20 delta call. Over the course of, the 10 days before expiration, if nothing happens, you are getting longer and longer and longer delta. Why? Because the calls that you have against the long stock that you have are losing their power, right? They're losing their delta power to counteract all the stock. And so you're getting longer delta. You have to sell delta every day. You sell stock every day. And it's just something that you have as a function of your position. And especially towards the end of my career as a market maker, that is the majority of what I taught people is how do you, A, forecast that, react to it, artistically and originally try to think about strategies to either get out of it proactively or manage it before it becomes an issue. And so I think the answer to this question is yes, they embrace the gamma / Vega drift overnight because they have to, right? It's just a part of managing your position. Does that answer your question?
It was a great answer to the question. Tough question. Blue usually brings the heat with his questions. So, we're 5 minutes away hours. I'm gonna leave this last one with Mark Rucker. Mark, I think I always mispronounce your last name, so I apologize for that. But Mark says this is an odd question. Matt, I know enough about you to know that this is you. He says that back in the 90s, he used to frequent Eckerd Park Gym in Chicago, and he remembers you because does he possibly play the saxophone? I'm pretty sure that's you. So for those
oh my God.
Yeah, Matt is an incredible. It is saxophone, right?
Yeah, I've been a saxophone. I was a saxophone player long before I was a trader. That's what I went to study I went to study at Northwestern. I studied saxophone performance. That's what my degree's in.
Yeah, and you've done some really great podcasts recently where you put all that out there yourself. So I didn't dox you.
Oh, yeah. No, that's amazing, Mark. It's a pleasure to run into you again virtually. That Eckhart Park is a Chicago park facility that used to have a gym in it that was right down the street from my condo at the time. That is hilarious. Amazing. Mark, thank you for saying hello.
Yeah, it is a small world. So, Matt, we'll wrap it up there because I know we're over the hour, and again, I want to remain respectful of your time. We already stole a little bit extra, so I can't thank you enough for coming to talk with us today. And I'm hoping we're going to do it again soon. If people want to kind of get in contact with you or learn more, get more education, what's the best resource? Where should we point them?
Yeah, so there's two things. One is I'm pretty active on LinkedIn. So if you want to talk to me specifically, you can always find me on LinkedIn. My name's Matt with 1 T, M-A-T, Cashman on LinkedIn. And then the second thing that I always try to highlight for people is that the OIC, the Options Industry Council, again, is the educational arm inside the OCC. We have all of our options education stuff that is it's a wide range of assets that you can find at www.optionseducation.org, and it's free and it's available to the public on demand. It's a great resource that I think is underutilized. Part of what I do is try to make sure everyone knows that it's there for them, and it's there for that very reason. It's there to help you understand options better and to make you a more well-informed options trader. So that's it. That's my plug.
Yeah, all right. And you've been nominated to join once a week. I think it's a little aggressive, but you're welcome. I guess people like it. And this recording will be available via the resources page. I think I can't say whether it'll be on our YouTube, maybe private. There's a chance it's public. I really don't know. I don't control that kind of stuff, but it will be on the resources page for SpotGamma members. And I think Matt will be sharing some clips at least and things like that. So you'll be able to get at this content again, and it'll be there for everybody here. All right, and that wraps it up for us. I'm going to go trade my HIMS 1x2s, and hopefully I cash in big time.
Good luck and Godspeed. All right, see you later.
See you.